I made a video recently where I covered 3 stocks that I think would double in 2020, and those companies were Toll Brothers, Wayfair, and Discover Financial. As it stands today, Toll Brothers is up 96% from its lows, so almost a double there. Wayfair is up nearly 300% from its lows, so almost tripled over there. And Discover Financial is up about 80% from its lows, so not quite double just yet, but we're almost there. So in that video, I told you guys that I did own one of those 3 stocks, and in today's video, I'm going to reveal which one that stock is. And I'm actually going to share with you guys as well if I plan to buy any more of this stock after its recent run. If you enjoy this kind of video and you want more reveal type videos like this, make sure to hit that like button down below. It helps the channel out tremendously and I appreciate the support. So funny enough, based on that video, many of you guys guessed that I owned either Wayfair or Discover Financial. I think Wayfair actually may have got the most number of guesses on that video, and funny enough, it did perform the best out of the bunch. But no, unfortunately, I do not own Wayfair. However, my theory in that video on Wayfair was pretty much spot on. A few days after that video, the company did come out and they posted an announcement saying that they expect to beat their guidance due to an increased demand of people who are ordering from them in the last month or so. And this makes perfect sense if you watch my video because it's exactly what I went over. I believe that people would be buying a lot more home office furniture, and I think that Wayfair was the logical option because they offer the best value, quality, and price out of any other retailer out there. Anyways, getting back to the meat of this video, revealing one of my positions here in my portfolio. The stock I actually hold out of the 3 is Discover Financial. So let's talk a little bit about this company, kind of go into some details on this stock itself, figure out why it has dropped so much, and figure out if the stock is still trading at an attractive valuation and if it's worth buying more shares at these current prices. So Discover is a digital banking and payment services company in the US, and it's one of the 4 major players in the credit card space as well, between Visa, MasterCard, and American Express. Now, Discover is the smallest of the bunch and often gets overlooked because of this, but I think this is a very interesting company that can quite honestly see a lot more upside in the future. Now, along with its credit card business, the company also does loans. And over the last few years, Discover has seen a strong compounded annual growth rate on their loans business, which signaled that this company was doing things right. They offer both student and personal loans, and some of you watching may even be their customers. Looking deeper into their loan growth, because it's a crucial part of their business, we can see across their segments, they had a good Q4. Everything grew quarter over quarter across the board, and the economy was in good standing at this time without any issues on the horizon, so things were looking good for the company. You can also see here the kind of interest they were making from each segment of their loan business, and things for the most part, in my opinion, look strong and healthy. Personal and credit card loans led the way with over 13% interest that Discover pulls in from its customers, making up majority of the loans outstanding. And as with any loan business, the delinquency rate is important to note, and in Discover's case, it breaks down its segments here. We see around 1.5 to 2.5% delinquency rate across their different loan divisions, which honestly is not too bad. Remember, they are earning quite a bit on the interest side, so they can afford to have delinquencies at this rate and still continue growing year over year. So overall, in 2019, it was a strong year for the company. They managed to hit or exceed pretty much all of their guidance figures they put out, and investors were happy with how the business performed for the year. As a result, 2019 was an amazing year for the stock. It was up over 50%, which well outperformed the broader market. And it did all of this while offering a nice dividend as well, but we'll discuss that more in detail in a few minutes. Now, going into 2020, they had some high hopes for the company this year. They saw 5 to 7% loan growth in the business at the rate things were moving, and this in turn would help Discover continue on its path for maybe another year of 50% gains. Well, unfortunately, from the time that they announced their Q1 guidance and fiscal 2020 guidance, things have changed. Many bills are not going to be paid, and as a result, Discover is going to get hit pretty hard here in the next few months. And as a result, the market saw this coming and it priced in some pretty drastic changes here for Discover for 2020, resulting in the stock price dropping around 75% from its all-time highs last year, which is quite a drastic drop in the business. But of course, the question now as investors that we have to ask is, was this an overreaction by the market? Is this a potential opportunity here to get into this stock, even at current prices, for potential massive upside? I'm talking 2 or 3 times your money in the span of a few years. So here's the thing with Discover. The risk is that while they have a good amount of cash on hand, almost $7 billion, and they have no short-term debt, which again looks really good, they do have a lot of liabilities. And now this is expected because they are in the loans business after all, so they are expected to always carry liabilities as they lend out money. The risk with this, however, is that if we see a rise in delinquencies, Discover will hurt badly and have to take some big losses, which in turn would put them in a very tough situation. If people lose their jobs, the last thing that they're going to do or want to do is really pay off their student loans or pay off their credit cards. In these situations, priorities typically go to paying off rent and getting food on the table for themselves and their families. So this does not sound good for Discover at all. However, remember, there is a special circumstance right now. The government is actually paying people $1,200. So depending on where they live and what their rent is, they may still be able to cover their rent payments no problem, cover their food no problem, and still make some payments towards their loans. Of course, naturally, I expect to see a rise in delinquencies here, but I think because of these $1,200 relief checks that's being sent out, the numbers of people that completely go bankrupt or default on their loans will be much lower than initially expected. Remember, the stock initially dropped because we did not know what was going to happen. We had a feeling that we're going to a massive recession, and we had no idea the government would actually step in and help every individual. Also keep in mind that yes, although many Americans are out of a job currently, the overwhelming majority is still employed and still working. So it's not like we're going to see 50% delinquencies here. And if I had to guess, and this is a pure guess, I'd say we can see anywhere in the range of 5 to 7% delinquencies versus the usual 1 to 2%. And if things get really bad, we could see it reach near 10%. But keep in mind, if things recover like we expect in a few months and these people who are out of a job currently are able to start working again, things will quickly recover and we're not going to see these drastic figures. Now in 2009, for reference, during the Great Financial Crisis, we saw Discover come out and say they had nearly 10% charge-offs, meaning that there's no way that they expect to be paid 10% off their outstanding loans. So they write it off as a loss, and this is something we could see happen again depending on how long this issue continues. But again, remember, during the Great Financial Crisis, people were not receiving $1,200 checks, so if they had lost their job then, they were literally receiving $0 in income. So this case is a bit different, it is a bit better in Discover's favor here, and in that sense, they do have some money coming in. Nonetheless, this is a big risk when it comes to investing or potentially investing in Discover. But the question, of course, do I think that Discover could potentially go bankrupt from this? Absolutely not. I also do think that if things get extremely tough for the company, that the government will eventually step in, give them some relief aid, and then they can continue moving along their business. But now you kind of understand why Discover, for example, dropped so much more compared to other credit card companies like Visa or MasterCard, because they carry loans, they carry more risk, and Visa and MasterCard are pretty much pure transaction-based companies, so they don't really carry any loans. And because of that, there's a lot less risk associated with those businesses, which is why their stocks didn't really take that much of a hit. They're probably going to see a decline in revenue for sure, and profits as well, but there's no risk of the company going through some financial struggles because of what's going on when it comes to Visa or MasterCard. Whereas with Discover, we could potentially see some financial struggles. However, looking at this from the positive side, this situation gives us as investors a good opportunity to pick up Discover at a cheap price. I mentioned before the stock also pays out a dividend, and you can see that they have a solid yield of 4.5% currently, a payout ratio over 22%, and a 5-year growth rate of over 12%, while consistently growing the dividend for the last 9 years. This shows us that they were in good standing before this issue came up, and even if they temporarily suspend the dividends, once we get past this issue, I have no doubt that DFS will be back on its feet, rewarding shareholders once again. But just keep in mind that if you do choose to wait to see what happens here, at that point, the dividend yield may not be anywhere near as attractive as it is today. Right now, the yield is sitting at 2 times what it usually is at, so you're getting some extreme value here if the company continues to pay out their dividend, which I think that they will. Honestly, because they have a good amount of cash and their payout ratio is extremely low, I think Discover will be able to maintain their dividend at a minimum. And as a shareholder, this is just an added bonus because the true value here with investing in Discover today is the opportunity with the share price appreciation, in my opinion. So here's what the stock currently looks like. It's sitting at around $40 per share, down from around $80 per share just 2 months ago. Now, if the global issue can get past us in the next couple of months, I would fully expect Discover to be back around the $50 to $60 range. I don't think that we'll recover 100% to where we were before, which is around $80 or so, because we will surely see some defaults and losses on their loans. 2020 will also most likely end up being a bad year for them with losses, but I see this as a short-term issue that will be a non-issue in 3 to 5 years. That being said, even if we do recover to say $60 per share, that's still some good upside from current prices. I think the PE ratio is also a good valuation metric to use for these kind of businesses that over the long term are relatively stable and have consistent growth. Right now, the company is trading at a dirt cheap PE. And as you can see, its regular PE on average is around a 10 versus where it is right now, sitting at around a 4. So in my opinion, once again, Discover looks extremely undervalued. And although 2020 estimates are going to be out of whack for sure, we can look at 2021 estimates to get a better idea of where Discover is expected to stabilize at over the next couple years. And even with that metric at its current price, it's expected to be at a PE of around 5. So once again, very undervalued based on its historical PE. So I would say based on the metrics that I like looking at here for companies that are undervalued, things are pointing in the right direction here for Discover even after we've rallied 80% off the lows. The company, in my opinion, will weather through this storm that we're going through right now. And in the next few years or so, I think the stock will easily double or even potentially triple from current prices. And because Discover is considered kind of a higher risk stock today, you actually have a lot of potential to really accelerate the growth of your capital here with an investment in Discover, because in general there's a lot of fear around this stock right now, so investors are choosing not to invest until things look a bit clearer. But that's where the opportunity lies, in my opinion. If you've done your research, you've done your homework on this company, you understand its business, and you can see it getting through these times. It did get through the great financial crisis, so that's something to keep in mind. I think the opportunity here to at least double your money in the next few years is extremely high. And it's funny because if you follow this stock, you'll notice that on days that the market is actually rallying, the overall general market, say the S&P is up a few percent, Discover is actually one of the leading stocks on those days, which kind of tells me that investors are just waiting to get back into the stock, but they're waiting for good news first before they can do that. I've seen so many days in the last couple of weeks where Discover is up 10% or more on the day, and I think that's going to continue as long as we continue seeing positive news and progress on this global issue. Keep in mind, this is a relatively smaller business right now. It's a $12 billion company, and because of that, it can actually move much quicker than larger $120 billion companies. So again, that's another huge opportunity here for a potential investor. So I know this video was long, guys, but I hope this motivates you to maybe take some more time to look into Discover Financial to see if this is a company that's worth a potential investment and a spot in your personal portfolio. Remember, this is not investment advice here. This is just to give you guys an idea of the companies that I'm looking at, the opportunities that I'm looking at. And I wanted to share that with you guys here because I think that this could be one of the biggest opportunities that we're seeing right now. So of course, am I planning to buy more Discover for me personally? The answer is yes, but depending on the stock price. So right now, I think we're actually seeing some great value here at under $40 per share. But I'll let you in on a little secret. I was buying the stock when it was in the 20s. So it's kind of hard for me to buy some more here at 40. But that being said, the metrics do show me that it is still undervalued looking a few years out. So I may actually continue adding to this position in the near future. If we drop below $30 per share, it's almost certain that I'll be adding heavily once again to this stock. So let me know in the comment section down below, first of all, if your guess was right on Discover, if you thought this was a stock that I owned. And second of all, if you are planning to look into the stock and potentially invest in the stock in the future. I'd love to hear your thoughts in the comment section down below, guys. But either way, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one.